Hey, well, thanks very much, Andy. I'm sure everyone on the call knows Andy Halford, who's the CFO of Standard Chartered. I think the format. Oh, we got one more joining there, I see. Hopefully they can hear me. I think the format is I'm going to sort of channel the questions. I've got some questions, obviously, but if anybody has particular issues they want to ask Andy, then if you just drop me an email, then I can, I can ask him directly. Hopefully, I'm going to cover most of the issues that that are relevant, but you never know. I might fail. So, can we start off, Andy, just about with the sort of the return on tangible equity goal of 10%, which is has been a goal of Standard Chartered's for some time. Obviously, events have pushed the timing back, at least. I mean, just wondered, is this still a goal that you think is possible to achieve in, say, the next 2 to 3 years, or has it become more of a long-term aspiration that might need a stronger or earlier economic recovery, or perhaps a shift in interest rates for you to achieve? I just wondered if you could update us on your thoughts around that sort of 10% or better ROTE target. Thank you.
Yeah, so the 10% we have clearly had out there for some time now, and we remain of the view that is the sort of North Star that we should be aiming for. And in some respects, it's sort of quite disappointing that, well, COVID happening is disappointing in many ways, but specifically to the trajectory that we were on. We were actually making pretty good progress. When we first sort of talked about getting up to 8, then 10%, remember back in 2015, we were slightly negative on ROTE. So we had actually covered a lot of ground. We came into the very, very early start of this year, I think, in pretty good shape. And the first quarter numbers sort of really bore that out. And then obviously COVID has set things back for not just us, but for most of the rest of the world. So our view remains that the 10% still is what we should be gunning for over a period of time. There clearly are a number of Asian banks operating in not dissimilar markets to the ones we're in who do achieve that, and therefore it sort of seems like an ambition that if others can achieve it, why shouldn't we be able to achieve it? The exact timeline to achieve it is slightly tricky, in that it really is very dependent upon a number of factors. One is interest rates, clearly, self-evidently. The lower they stay, the longer it will take. But conversely, if over a period of time we did see some pickup, that would be helpful. And then secondly, we have got the big question of just how fast do countries manage to pull through the COVID period? When does a sense of normality start to prevail? And when do economies start to get sort of back on their feet? So we'll provide an update in February when we do the full year results. And by then, hopefully, we'll have a little bit more evidence, another couple of months maybe, of vaccines and early days effectiveness of those. So I do think it is something that we should absolutely aspire to get to. The exact timeline is a little bit fickle at the moment. We'll do it as fast as we safely can do it. But we're also going to be quite thoughtful about sort of balancing the longer term against the nearer term. We are investing a fair amount in digital and pushing pretty hard on all things digital. That requires a bit of investment. We could take that investment out and maybe hit ROTE targets earlier, but I'm not sure in the longer term that would be the right thing for the business. So we will try to be sort of thoughtful about that balance of repositioning the business for the longer term versus obviously getting the ROTE up to the levels that everybody wants the business to be at.
Okay, thanks for that. If I can maybe just pick up on a couple of things you mentioned there. Firstly, how quickly different countries are going to recover, and then also your comments on interest rates. We hear a lot of reports about China and how China is already recovering, certainly more quickly than we're seeing in the US and Europe. I wonder if you could comment though on, is this also true for Hong Kong? Obviously, political tensions remain high, and some of the recent news in the last couple of days sort of underlines that a little bit. And the border with mainland China remains closed as well for now, which I guess also has an impact. So Asia itself, if you could talk maybe about Hong Kong and some of the other countries a little bit as well, would be great. And then on the interest rates, obviously, interest rates is an important driver of your revenue going forward. Just felt that the fall in global rates might have taken you a little bit by surprise. Not the only bank, I think, but I just wonder how confident you can be now that margins are going to stabilize, say in early 2021, and we're not going to see the impact of rates sort of taking longer to feed through, and therefore more downward pressure on revenue in 21 than perhaps people are currently looking for. So those two issues, if you could maybe add a bit of colour to that, would be great.
Yeah, no, sure. So let's take the first one first. We are seeing more resilience in volume picking up in China and in Northern Asia more than in other parts of the world, for sure. There's obviously been a lot in the media about sort of US and Hong Kong. Certainly, as we see it in China at the moment, actually, the levels of economic activity are picking up pretty nicely. And certainly when we talk to our people in China and Hong Kong, they are sort of closer to life before we had COVID, maybe not quite there. And Hong Kong has had a little bit of a resurgence. Little bit depends upon your definition. In other countries, it would be minute. In their sense, where zero has become the sort of acceptable level, it has spiked a little bit. But overall, it is just gently coming back. And we've seen that with corporates, and we've seen that certainly on the wealth management side in the consumer space. I think Southern Asia, and particularly Singapore, is showing encouraging signs. It is not as advanced in that journey as Hong Kong is. And I should say actually that the experience in South Korea is pretty good as well. So the sort of Northern Asia sort of swathe, which of course is a big part of our overall profits, is doing pretty nicely. India, even though they have been struggling with COVID and getting on top of it as a country, actually, again, we've seen activity levels pretty strong. Middle East and Africa, I think, is sort of another sort of step behind. In some senses, I think people were very worried about Africa sort of 6 months ago, and that with the challenges of putting financial support in place, that some of those countries would really suffer. I think it's been a bit better than people maybe had expected. Maybe lower life expectancies, maybe previous sort of issues for which they've actually got medical sort of support in place have actually helped there. So Africa is still sort of bumpy. And then for those of us who live in Europe, maybe the US, clearly it still feels to be a little bit sort of 2 steps forward and 1 step back. Now, whether or how quickly that latter point will change with the vaccines actually now formally coming into play, clearly won't change things overnight, and the audience, I guess, for the vaccines early on will not necessarily be those who are going to change economic behaviours quickly. But I do think when we get 3, 4, 5, 6 months down the line, and hopefully there's been no adverse sort of reaction to them, that sort of sense of belief that actually we are now sort of on the back end of this whole issue, I do think should give us confidence that things will then pick up across more countries. And just stepping back at a very macro level, at the end of the day, there will be roughly the same number of people on the planet after COVID as before, roughly. The level of consumption, the level of ambition people have got, is still going to be out there. So I do think we'll look back on this sort of as a timing sort of issue of substance, but a timing issue before the world gets back more to where it was previously. On the interest rate side, look, no bank, I guess, well, particularly those that were operating outside of Europe, had the experience of operating at the levels of interest that we're now operating at. And very few people would have predicted a few weeks before March last year that we were going to see such a big correction in interest rates very quickly. And therefore, I think it was quite difficult to sort of accurately forecast just how quickly that would ripple through both the asset and the liability side of the book. We do feel that the majority of that repricing has now happened or is within weeks of happening. And the fastest sort of elements of that happened sort of in the treasury space, where we essentially got that correction on pricing pretty quickly. So as we go into next year, I think 2 or 3 things. One, there is much less of the book to reprice. So unless there is another further change in interest rates, it does become more predictable. Secondly, we did end up last year, or we will end up this year, we ended up the third quarter with quite a lot of liquidity sitting in the centre with the Treasury team, the central banks. If volumes do pick up, the ability to deploy that and earn sort of commercial margin on it rather than central bank margin, then that will be helpful to the cause in terms of maybe the margin stabilising to marginally picking up. And then a number of initiatives that we've had underway, and I'm sure most banks have, to just progressively take out some of the higher cost sources of funding and to replace those with the lower cost but nonetheless sticky sources of funding. So I think going into next year that we should have a more predictable interest and hence margin environment than was the situation in this year, when it was obviously a bit of a fire drill without any great rehearsal.
Super. Just maybe linked to some of those things. One of the clients is pointing out that looking at your footprint, geographic footprint, you know, Hong Kong and Singaporean banks, you're not too dissimilar, yet your returns compared to some of those, I think you mentioned yourself, are, you know, lagging that sort of peer group. And the question is really, what part of your business do you think is continuing to hold back your returns versus some of those peers, you know, which are making better returns today? I mean, you've talked of interest rates. I don't know if that is the answer or if there's other drivers there.
I think there's a number of factors come into that, and some of them are sort of quite long, quite historic. Some of those banks maybe have a slightly higher proportion of their activity that is retail, and off the back of that have a higher proportion of very low cost sources of funding. That can give a bit of a margin impact that, or benefit that we would not have. Secondly, and again, it's a sort of statement of the inevitable in this sector, the sort of benefit of scale. If you have a $100 billion bank operating in one country, it tends to be more cost efficient than a $100 billion bank that's spread across 100 countries. There is just an extra cost of regulation, of control, etc., across many markets. So I do think that the network side of things for us, and you can see it in our cost income ratio, is a bit of a disadvantage compared with some of the regional players. It's not an easy one to fix. A lot of our business actually equally is dependent upon the referral of activity from different parts of the world. And one can look, for instance, at our African markets, or if you take our smaller markets, I think the smallest 20 markets are probably about break even. But on the other hand, they generate about $500 million of income that is actually booked in the bigger markets. So we're quite intertwined, and the work we've done over the last 3 or 4 years to actually really work on the cost side of it, to focus upon the IT side, digitalization, etc. I think that is just a journey that we have to really, really pursue, and a belief which I do strongly have that actually we can put more income through the machinery that we have got. So when things do start to pick up, I think we should be able to keep a pretty good handle on the cost side of it and be progressively able to handle more income and hence get the financial gearing benefit that comes with that.
Can I ask a question about provisions before? So, Andy, one of the things that I think we saw in the third quarter is that things were more benign than we thought. It is not just for Standard Chartered, certainly for your regional peers, certainly for your closest, I guess, comp, which is HSBC, right? I mean, and when you think about it, and you look at your geographic mix just based upon your loan book exposure versus, another European bank or an American bank, you're in geographies that are much more resilient right now in COVID than the West, frankly. I understand you have a mix of exposure and whatnot. It's not perfect, but in terms of, being exposed to only the most resilient countries, but isn't the lesson from the third quarter that, if anything, people got a little bit ahead of themselves in the first and second quarter, or that the provisioning, at least the forward-looking provisioning, worked and was conservative, and that we should start to see releases, if anything, into 2021? Is that fair?
Well, I think the genesis of it is fair, and I think there are sort of several moving parts under it. I suppose for some people, they still remember Standard Chartered back in 2015 when, if there was a banana skin to slip on, we managed to slip on it. And I do think we have done a huge amount in the intervening period to actually tidy up the balance sheet, reduce the concentrations of risk. And I genuinely think we have come into this period with a much, much better balance sheet than we had before. The second point I'd make is that for banks generally, I think there is a huge correlation with the efficacy of government policy. If governments had basically said, sorry, we're not going to put our hands in the pockets, we're not going to try to, help businesses, etc., we're just going to see how it goes, I think we would be sitting here seeing much more bad debt exposure across the sector. So the fact that there is, I believe, a very strong alignment of, for slightly different reasons, but a strong alignment of what governments generally are wanting to do. They're sort of seeing that the vaccine now is actually enabling one to think of a time when actually this is behind us, that therefore the period that they sort of still need to actually subsidise the economies to keep them going isn't too long into the future. And I think that is a very large part. I mean, you can look at a different element of this and say most of the Bank of England stress tests over the last several years, which have had situations that have looked pretty bleak, and you can argue COVID was just as bleak as the rest, but they have had typically 5 percentage points of drawdown on capital. What's actually happened? We haven't even got drawdowns, we've probably got draw ups. And I think the single biggest reason for the delta is the level of government support. So I do think that is quite a big factor. Thirdly, you are absolutely right that actually when you look back at the sort of credit history we have had in good times, actually our Northern Asia business behaves remarkably well. And its credit write-off as a proportion of, let's say, income has consistently been really, really quite low. And it is the biggest part of our business. So I do think that should be helpful as we go forwards. Fourthly, sorry, these are in no particular order, but just a few thoughts. This links a little bit back to the previous question, but for a different reason. We have got a slightly lower proportion of retail in our books than maybe some banks have got. And actually, we've got, therefore, a lower proportion of unsecured retail. And certainly, if you look at some of the provisioning in the US, for instance, that has been taken against unsecured retail books. Actually, that's a much less significant part of our book. And where, for instance, there have been moratorium periods, the proportion of those that have subsequently started to repay, and even the ones that haven't, but are secured lending, is really quite a high proportion of our book. So I think going forward, to sort of pull it together, the stage 3 provisioning, which is the sort of actual bad debt experience, will be the more significant going forward. I think the stage 1 and 2, which is all the modelled stuff, I think largely speaking, banks had to top those up pretty aggressively in the early part of this year. And generally speaking, as GDP growth rates, etc., start to normalise, that one should see those, the stage 1, stage 2 charges either reducing or sometimes it could be actually reversing out. So I think for us, the real issue is how many of these businesses that have got through, a pretty rough 6-7 months, actually with support, particularly from government, think that with another 4 or 5 months ahead, whatever it is, something like that, they can just about get across the line. In which case, I think actually the sector, will come out in better shape. And although this may well be cutting ahead to a different point, when we get onto the sort of issue of when will dividends be allowed, as I say to a lot of investors, clearly if one as an investor needs the cash from a dividend, this has been a particularly unpleasant period. But I actually think the more important thing is actually how much leakage of economic value out of the system can we minimize in the next few months? Because at the end of the day, if we can minimize the credit losses, that value will be sitting in the banks. It will come out at some point in time. It's just a question of when. If we have a very bad experience on the credit losses, then obviously it's just not in the entity and it's not there to come out. I mean, it's a slightly different point to your question, I know, but I'm a little bit more positive looking forwards now, particularly sort of seeing the vaccines coming through and seeing the hard evidence that governments really are wanting to tide themselves through this period.
So let me just.
Can I? Sorry, David. Don't want to interrupt you. Can I? Because there's so few of us on this call, if it's okay with you, I think we'll keep it open format because I don't know, David. The original plan was they're going to channel everyone.
Oh, I'm sorry, I didn't realize that.
No, I think you missed that.
Only a couple of
at the beginning. It's okay, but it's just so if Andy's okay for the other guys on the call, are you all right to move to a more open format?
Sure.
Andy?
I will answer whichever question comes first.
Okay, guys. I mean, I'm happy to step in whenever, but if you have questions, then please
Sorry,
go ahead.
Tom. I didn't mean to step out of line with the.
No.
With the rules.
I just think you missed at the beginning. That's fine. Absolutely. Go ahead. It's your meetings.
Andy?
I lost my train of thought. Come back to me.
I'll jump in if you don't mind. Hi, Vincent McBride from Lord Abbott. We're relatively new shareholders. Stock's very cheap. But I had asked the question earlier on returns versus the Hong Kong Singapore peer group. I followed your stock for a long time, and I think of Standard Chartered as a little bit of an orphan stock, right? You're listed in London, but the bulk of the business is far away from London. And just again, take whatever peer group you want to define it as, but just being overly simplistic, Standard Chartered, Bank of China, Hong Kong. Standard Chartered shares all in Hong Kong dollars underperformed year to date by about 30%. And as I think about Asia Pac doing better, Greater China doing better, isn't this the type of environment that Standard Chartered should be outperforming? Certainly the European peer group by, and yet it gets lumped in with the London and European banks, both in terms of coverage, in terms of discussion point. How can you start to differentiate the performance of your business versus the peer group?
Yeah, Vincent, I think there are 2 or 3 questions sort of within that. First of all, I think the numbers need to start doing the talking. If we are seeing that having a higher proportion of our business in Northern Asia, and Northern Asia is coming out of this period quicker than other parts of the world, then we should see that starting to come out in our numbers more than businesses that don't have that sense. So I think the next 2 or 3 quarters and just how that plays out is going to be important. Secondly, and this is a very different point, an orphan is a descriptor. We are definitely difficult to get a good point of comparison with. In some senses, HSBC's sort of business model is not too different to our own, but of course they do have a huge UK retail entity that we don't have the equivalent of. So to that extent, it's not quite comparable. A Chinese bank typically won't have quite the same presence. So actually, the points of comparison are more tricky. thirdly, the question about sort of the share price performance and so on, there's an oft asked question, and one which we go through quite frequently, which sort of says, is the London listing, actually a problem here? If we were just out and out listed in Asia, would actually we be seen as being an Asia stock, and actually then there would be an uplift in the share price. If it was that simple, we would not hesitate to go and do it. But I think two reasons why one has to be quite thoughtful about it. One, I think that the bigger correlation of share price is actually the correlation with the return on tangible equity. And whether we take our current return on tangible equity and have it in London or have it in Asia, if it is still low, we are probably going to end up still with a lower multiple as being our share price, which actually takes you back essentially to Tom's first question, that is the thing that we most need to work on. The other one, and I know this wasn't quite explicit in your question, but was maybe implicit in it, is even if there were clarity on that point, it is quite a difficult question as to know sort of where one would go to. We have got big businesses in Hong Kong and Singapore, so you could sort of say, well, that's obviously the choice you've got to make. But at this point, with political tensions as they are around the world, a decision to go and say, right, actually, let's make Hong Kong more of our base, has pretty big ramifications. 60% of our total business activity is transacted in US dollars, courtesy of a US dollar license, with a government that isn't wholly enthused by what is going on in China and Hong Kong. Do we actually go and pitch ourselves right into the middle in the vortex of really quite a difficult situation, even more than we're in at the moment? Conversely, if one said, no, that is all very tricky, maybe Singapore is the better way to look at it, is that going to be taken by some people as being a tacit decision not to go and support the sort of Chinese Hong Kong end of it? And we know which mast you've coloured nailed your colours to in the opposite respect. And it is just genuinely quite tricky, and they are big decisions. And they're also sort of multi-generational ones as well, because really once you've made that decision, most businesses don't change domicile at all, let alone often. And you could easily 5 years ago have looked at the situation 5 years ago and said, well, if you're going to make the move, then obviously Hong Kong would be the place to go to. 5 years on, and you go, okay, that's not quite so clear cut. So I think you sort of come back to the point. There's something which we need to be very, very focused upon, which we are. But actually, the sort of neutrality that actually comes from the UK is sort of, has got advantages, or let's put it this way, disadvantages that aren't actually quite as big as they might seem relative to the other points of comparison. And if my point about actually it's getting the roti up that's really going to matter, that actually is sort of a little bit agnostic of country and nationality. That's more one of actually get the engine to turn faster and get the business performance to up quicker.
Thank you.
Okay, David?
So corporate finance kind of 101 would say that if you're trading at under the cost of equity for long periods of time, shed assets. I mean, it's you could sell things at book. That should improve kind of the ROE in general, or at least the book value per share. Is that something that you would consider? I mean, are there assets that are books of of business or portfolios that you'd consider shedding now, just that might get a higher valuation, that might be a way to improve the or even businesses, even units, that might be a way to improve the performance?
So I think the tricky thing with us is this. If you go back over the last 3 or 4 years and you looked at us in terms of, are there particular products that are just loss-making or tying up capital that is just not making a return, you'd go, yep, there were some. We were in cash equities, we got out of it. We were in principal finance, sort of private equity, and it had some good years and then it had some pretty poor years, and we've got out of it. And actually, if you look at the products we're left with at the moment, there are none of those that are loss-making. They may not be making as high a return as we would like individually, but they're not loss-making. So you sort of go, okay, so from a product lens, it's not an obvious sort of chop that limb and you'd be in a better position. And then if you go through it with the alternate of a geographic lens, you say how many of the businesses, countries we are in are overtly loss-making, and you go very, very few. And you go, okay, well, you know, if you had some of the loss-making, and a good example actually of that would have been Korea back in 2015, we were losing a lot of money, and people said, you know, go and sell it. Well, slight problem was at that time, this is history, so I won't spend time on it, there were not very many people interested in buying a loss-making business in Korea. And actually in Korea, we changed the management and we have now got that sort of making 300 million a year of profit. And actually, my view is that if you can, it is far better to try to improve the performance of what you have got. The process of extrication, you know, can be quite time consuming. And then the other point, which I made a reference to earlier, and again, this sort of sounds like an apology, it's not really meant to be, but this networked element, the amount of referral activity that does go on between the businesses, you have to be quite careful about. You know, you could look at sensibly and say, and I haven't got all the facts here, but you could look and say, gosh, you know, Africa, just, you know, lop it as one. And you then look at two effects of that. One is how much of our business, well, three effects maybe. One, how much of our business is in Africa. The second is how much of our business in the rest of the world do we sort of get courtesy of the African connection? And then thirdly, if we didn't have Africa, does our calling card, when a corporate is thinking about doing something in Asia, start to no longer look particularly differentiated from any number of other Asian banks? And I mean, all of this will sort of sound like I'm saying no to ever doing anything, and that's not the case. But my strong view is that actually, if we could, for instance, say, let's take retail. So we have got a lower proportion of retail. We've got 7 or 8 markets where we're reasonably strong. We've got another 12 where we are quite low on market share. One option is to say, okay, with those 12, just exit. You know, it will free up a bit of risk-weighted asset. It might free up a little bit of capital. An alternate is to say, well, before we actually give up on that, why don't we look at it slightly differently? In a world that is becoming much more digital, where people are banking far more on mobile devices, if you can get a technical stack that can actually support a much larger number of customers that is very digital, doesn't have a high cost of operation, if you associate that with an existing license, which we have got, and with a brand reputation that's, you know, generally reasonably sort of positive and supportive of safe, sound, and all the things people want to be, why would we not instead give it a push and see actually whether we could make more of some of the markets that are a little bit more fragile? The experiment we've got going in Hong Kong with the new virtual bank called Mox is, I think, a really interesting sort of case study for us. A, it's up and running, so it's not just a theory. Secondly, it is a completely new digital stack that is unconnected with our core bank. Thirdly, it has got volume capability. Now we need to prove that, but we believe that it will have, and therefore, if you take the last 2 points, it potentially can be cut and copied into any one of a number of other markets. And we are also using it in Hong Kong, this could be elsewhere, to actually market it a bit differently and say, you know, the average existing customer is a 48-year-old plus. Why would we not target at the 30-year-old or thereabouts and see whether we can actually make more inroads into a very adjacent revenue pool that we don't maybe tap into as much as we could do, and it is absolutely tangential to what we do. So I don't rule out sort of the things you're talking about, but I struggle to find the long list of candidates, and hence why I sort of come back and say, I think the most important thing to do is to really try to drive the business forward, accept the interest rates have sort of given us a bit of a headache, but it is what it is, and now try to actually pull through this period. If there is any uplift in interest rates, it can only be additive.
So I appreciate that. I think, first of all, let me just say, I think, and I think I've told you this for a number of years now, Andy, that the fact that you have presence in gazillion countries is a huge competitive advantage, I think, because there's really very few others that have that. So you're preaching to the choir in terms of the referencing the business from maybe some of the smaller countries. I was even thinking, though, and as painful or as this might sound, I wasn't even talking about loss-making business. I was talking about some books of portfolios that are profit-making, but that the market is saying it's it's worth 0.4 book because it's in the shell of the entire firm or listed entity, and you can just say, you think it's worth this, but look, we sold it and it's actually worth a lot more.
Yeah, no, I understand correctly. I mean, your point is right. We could say, what's an example? Private bank. Lots of people out there would love to go and top up on a private bank, and it's probably a good example of what you're saying. We would get a multiple that is quite a lot higher. Yeah, we would do that. If we are trying to push more into the affluent space in Asia, where we do believe there's a lot of money still coming into the region or whatever, where does that sort of leave us as being a bank that's pushing into that space, but just doesn't have a private bank sort of higher end part to it? Is that something which is so big that you'd go, sorry, we're going to do it anyway, it releases a load of capital, we can take the capital base of the business down, and suddenly we got another 2% on our ROTE. Unfortunately, our private bank isn't of that scale where it makes a huge difference. And I come back to you and I say, great, we've done all that, and our ROTE is 0.1% higher than it was before. And you sort of go, yeah, okay, and you've now lost the option value of having that as an integral part of your affluent proposition. Was that really good trade to go and do? So again, it's not that we're closed to doing things like that, but I would rather try to build a business rather than dismantle it. And this is a very compelling, very clear-cut case that the latter is the right way forwards.
In fact, Andy, could you comment on, obviously digital is one area you think that you can generate additional revenues where you don't have maybe the scale today. I mean, other areas, I think Bill likes to talk about the opening up of China and the wealth management opportunity, because it does seem to me fairly crucial, this revenue story, because even if impairments normalize back to the 30-40 basis points, even if you hold your costs flat, with your savings offsetting investment and inflation, you've still got to get that top line growing if you're going to get the returns back to where you want them to be. So are there any other big drivers out there? Digital may be one. What else might we be seeing over the next sort of 3, 4, 5 years that's going to get the revenue back up to that sort of level it needs to be?
Yeah, so I agree with your summary. I do think that revenue is going to be really key here. If you look at the global banking revenue pool, about $5.5 trillion, and you say maybe 60% that's addressable by us, it's $3.3 trillion. We are 15 billion, sorry. We are a really small proportion of the total, and yet that sort of income is happening around the very fringes of what we do. And therefore you can either look at it as, oh my God, we're small and we'll disappear, or you can say actually you only need to get very small slithers of what is around the edges, and actually it could make proportionately a big difference to the business. One of the things that we have not pushed on over the last few years, but will push harder on now, is, you can sort of call it the mass market, but I suppose I'd call it more the sort of aspiring to be affluent market rather than purely those who are already affluent market. We have had a bit of a reputation of, sort of one day when you're 35 years old, you wake up in the morning, you realize you're affluent, the first thing you do is pick up the phone, get Standard Chartered, I must become, a customer of yours, and you sort of go, no, it's just not the way things are going to work. Kids of today are dealing with mobile phones from the age of about 2, and they're going to develop relationships with other parties. So we actually need to have a presence in those markets, I think, with a much younger age group. To do that, we're going to have to think about how we get that reach. And we're not going to do that by bricks and mortar, especially in a world that has got decreasing bricks and mortar. So this will be, I think, more about partnerships and it will be more about working with other people. We've got examples of this in China. We'll have an example of this up and running fairly soon in Indonesia, whereby we can say to, for instance, an e-commerce player who has not got any presence in anything to do with banking or financial services, but has nonetheless got a good e-commerce business that is maybe slightly higher end rather than the opposite, and who would like to be able to put sort of payment type capabilities into their shop window, and to be able to say to them, look, we can plug and play into your systems. You can front end this through your existing channels, but if you've got customers who are interested, whether it's buying your product or buying different product, we can provide the plumbing, we can provide the credit assessment, we can then go and service everything that comes with it. And so we've got a platform which we have called Nexus, which is in pretty late development now, initially in Indonesia with one partner and a second one sort of just about to be signed up. That again is a platform that is nationality agnostic. It is quite capable of being applied in other markets. So doing that sort of thing, possibly taking the MOX example back to the previous one and putting that in other markets, sometimes with regulatory encouragement, sometimes because that's what we want to do ourselves. So I think things like that, developing the product set on those, they'll sort of start off maybe more current account, savings account, but there is no reason why they can't extend into the pre-existing wealth management space. And you know, our sense is that there is a big revenue opportunity that is out there. It is not far away from what we naturally do. We just need to gear ourselves up slightly better to actually take our share of it.
Okay, we haven't got a lot of time left. I don't want to use it up with my own questions. If one of you guys has anything you want to, I mean, capital is the only thing we haven't talked about, but please go ahead.
Thank you very much. Thank you very much, Andy. This is Yekta from Strawberry Capital London. I just wanted to ask a question on NII, and in related to related to for last quarter of 2019. I just wanted to understand the reason of seasonality in the fourth quarter, as described in the last earnings call, I believe. And also, I just wanted to understand the outlook on the transaction banking. Thank you.
Yes, so the comment on seasonality was not exclusively an NII comment. It was more about the income trend in the fourth quarter does tend to be a bit lower. You do tend to find that corporates are tending to sort of shut off activity midway through December, and basically then, you know, allowing people to go off on holiday, whatever. And in the wealth management side, clearly you do get a sort of lull in consumer activity also for not dissimilar reasons. So I think the point we're making was that in a business that generally isn't too seasonal, the fourth quarter, because of the December effect, you know, one would tend to see a reduction, and we'd expect to see something similar to what we saw last year. On transaction banking, so what are we seeing there? We are seeing the sort of cash product side of things in a volume sense perform quite nicely, but in a margin sense be under pressure. So interest rate effects are clearly the ones that weigh down that part of the business. It conversely benefited over the last probably 3 years on the average from the sort of improvement in interest rate outlook, and then obviously that's recorrected. The trade side of transaction banking is sort of linked to one of the earlier questions. So seeing the volumes starting to come back more in Northern Asia and being a step sort of behind that in Southern Asia. But our view being, again, if vaccines, etc., start to come through, that we will start to see that normalization happening across more of the geographies over the successive months as we look forwards.
Super. Thank you. Thanks for that question. I think we're now out of time. Just before we go, can I get your thoughts on whether the PRA you believe will authorise dividend payments for 2020, and just a bit more broadly, you're clearly on paper sitting on surplus capital as of today. Just wondering what your plans might be for that surplus capital, and then I think we're going to have to wrap it up. Thank you very much.
Okay, so I think our recent history would show that we don't have a habit of sitting unnecessarily on surplus capital. You know, we have recommenced dividends. We had done 1.5 as it turned out, share buyback programs. So we are absolutely aware that if we want to get the ROTE up, one of the ways of doing that is getting the capital down. And what we do need to do, obviously, is just to maintain enough in the business to be able to fuel either forward growth or forward bumps in the road. I think the PRA are well aware that there was considerable disquiet in the investor community at the actions that were taken. Even if one understands why they were taken, it nonetheless, you know, for many, I think, was an intervention that was not appreciated, and I think they understand that. Equally, they as a regulator, I'm sure, are trying to balance that against not having a free-for-all, and then if the whole COVID thing sort of becomes more problematic for longer, getting embarrassed because actually it becomes a problem. So I suspect, like many regulators, they're just trying to work out whether there is a balance between those two, and how they articulate it, whether it be a general statement, whether it be a company-specific statement, or just how they go about it. They've said that they will say something in the fourth quarter. Obviously, the number of days remaining in the fourth quarter is reducing. So we'll see where we go. But certainly our minds are on the fact that we are sitting in a pretty good capital position. We don't want to sit on it unnecessarily. Although back to my previous point, I do think the biggest issue for us actually is going to be stemming the economic leakage that is known as credit impairments. And if we can do that, that value will sit within the business. It will come out at a point in time. And I think actually in a true value sense, that's probably the bigger issue.
Super. Okay, well, thank you very much, Andy. Thank you everyone for dialing in. First time I've done a virtual fireside chat. I don't know about you guys, but anyway, I hope it was useful for everybody. Yeah, and I think that's all for now. Thanks a lot.
All right.
Thanks, Andy.
Thank you
Thanks,
all.
Tom.
Thank you.
Bye.
Thank you. Bye.
Good luck with everything.
Thank you.
Thank you.